Good day everyone, we are Group 4 and our presentation will be focused on credit and collection.
My name is Juximi De Leon, and the first thing I will discuss is the introduction, and the next is credit in finance. Credit and collections. Generally, credit is defined as the process of providing a loan in which one party transfers wealth to another with the expectation that it will be paid back in full plus interest. The definition of collection is connected to the term credit. Collections generally refers to the current period sales and the credit sales of the last period combined. However, you can also define both terms in several other ways. Credit is when one person or business lends money or provides goods to another with the agreement that it will be paid back later, usually with some extra money called interest. Collections, on the other hand, refer to the money that a business actually receives from its customers. This includes payments for sales made during the current period as well as payments for credit sales from previous periods. In simple terms, credit is about giving something now and expecting payment later, while collections are about collecting the money that is owed. Credit in finance. A credit contract is a legal agreement whereby one party loans funds to another. The term of the contract specifies the amount lent, the payback date, and the interest rate on the loan. In other words, a credit is a contract of a loan or delayed payments of funds or goods. Credit can also refer to the borrowing capacity of an enterprise or individual. The term is often used to mention the terms and conditions of a postponed payment option, while the word credit also denotes the period that is offered for deferred payment. A credit contract is a legal agreement where one person or business lends money to another. The contract clearly states how much money is being lent, when it must be paid back, and the interest rate charged. Simply put, credit means a loan or an agreement to pay for goods or services later. It can also refer to how much borrowing power a person or business has. The word credit is often used to describe the terms that allow delayed payment, as well as the length of time given to make the payment.
Good day everyone, I am Jasmine Rose A. Silmar to discuss the topic about the credit in accountancy. In the realm of accounting, credit is a pivotal term that often leads to initial confusion due to its varied usage. It's important to remember that while credit in everyday language often relates to borrowing, in accounting, it's simply the right side of an account that follows specific rules based on the account type. Instead, it represents a specific side of a journal entry and ledger account, playing a fundamental role in the double entry bookkeeping system. Credit in accounting can be understood in the following ways. In the context of a journal entry, a credit is an entry that signifies an increase in liabilities, equity, or revenue accounts, and at the same time, it indicates a decrease in assets or expense accounts. Within a ledger account, the credit side is the right-hand side where payments received from debtors are recorded along with any increases in liability, equity, or revenue accounts. The term credit can refer to either a single credit recorded in the accounting system or the cumulative total of all credit entries. In a broader financial sense, credit line can also refer to a pre-approved amount of loan that a borrower can access. It is also important to emphasize the role of the double entry bookkeeping, wherein it is the foundation of accounting and credit is essential to the system. Every transaction affects at least two accounts. One is debited and the other one is credited. So, the double entry system, with its debits and credits, ensures that every transaction is recorded with two equal and offsetting entries. This helps in maintaining the accuracy and balance of financial records. So it goes like this. If the account is for something the business owns, which is an asset, or something that costs the business, which is an expense, then a credit on the right side means that amount is going down or decreasing. Like for an instance, there's an online shop that sells its old printer, which is an asset. To show that they have less equipment now, they credit the equipment account. The amount on the right side tells the value of the printer that they no longer have. On the other hand, if the account is for something the business owes to others, which is a liability, or something that belongs to the owner, which is the owner's equity, or the money that the business earns, which is the revenue or gain, then a credit on the right side means that amount is going up or increasing. Like for example, if an online shop takes out a bank loan, this increases their liabilities. They record the increase by crediting the loan payable account. The credit shows that they now owe more money. Another example is when we make a sale to a customer, this increases our revenue. We record this by crediting the sales revenue account, and then the credit shows that we've earned more money from our sales. So, remember, whether a credit increases or decreases an account depends entirely on whether that account represents something we have spent or something we own or earn. The right side isn't inherently good or bad. Its effect is determined by the nature of the account itself. In conclusion, the concept of credit in accounting, as the entry on the right side of an account, is fundamental to the double entry bookkeeping system. It serves as a mechanism to accurately record the increases and decreases in various financial elements. By consistently applying the rules of debit and credit, businesses can maintain a balanced and transparent record of their financial activities, providing a clear picture of their financial health. Understanding credits is therefore a crucial step in grasping the language of business and finance. That's all. Thank you.
I am Jenny Rosengonza and I'm going to discuss about the collection of finance. So in finance, collections refers to the process of a business gathering and managing outstanding payments owed to it by customers or other entities. So this is involved efforts to retrieve these payments, ensuring timely payment of invoice and reducing delicate accounts to maintain a healthy cash flow. So, sa madaling salita, ang collection ay ang proseso ng pagkuha o pag-receive ng bayad mula sa mga customer or client na may utang or may balance sa isang company. So, ibig sabihin, ito yung kinokolekta yung pera na dapat bayaran ng isang customer or client. So, for example, may negosyo ka and then yung mga binibenta mo is appliances on installment. So, si customer bumili ng ref worth 15,000 pero nag-down lang siya ng 3,000 at ang balance niya ay babayaran niya in 6 months. So, tuwing buwan, tinetext mo siya or tinatawagan to collect the monthly payment na 2,000. Kapag nagbayad siya, yung perang natatanggap mo ay tinatawag na collection. This is the importance of effective collection management is essential for business, which is ensure timely payment of invoice. This help maintain a stable cash flow and reduce the risk of financial difficulties. Then second, reduce delinquent accounts. By actively pursuing payments, businesses can minimize the amount of outstanding debt. Then third is minimize financial losses.
Efficiently collection practices help prevent significant financial losses due to unpaid debts.
Hi everyone, I'm Christine Joy Arvadillo. I will discuss about collection in accountancy. According to the book, Financial Accounting, An Introduction to Concepts, Methods and Uses. In accounting theories, credit stands for a journal entry that registers an increase in assets. Credit is also known as the part where payments of debtors are registered, which is typically the right side of ledger account. As a consequence, you can mean the aggregate of all entries or just a single entry with this term. Moreover, sometimes a credit line is understood as a credit. Collection is a term used by a business when referring to money owed to the business by a customer. When a customer does not pay the business within the term specified, the amount of the bill becomes past due and is sometimes submitted to a collection agency. In accountancy, collection refers to the process of receiving payment for debt owed to a business. This can include both cash sales or payment received immediately and collections on account receivables, invoice from customers who haven't paid yet. The goal is to ensure timely payment of invoices, reduce delinquent accounts, and maintain a healthy cash flow. So, the importance of collection in accountancy. Efficient collection management is crucial for a business cash flow and profitability. It helps ensure that the business receives the money owed and can be used that cash to fund operation and investment.